Good evening, everyone, and thanks for joining us on a Friday evening for what I can tell you in the pre-recorded session. I am sure it's going to be turning out to be a fantastic session for all of you. And just to sort of clear the clouds a little bit, this is not about the view on the market or the view on next year or stuff like that. This is, I think, talking about investing and a few things that we can learn from Sanjoy. The guest that I have today definitely kind of doesn't need an introduction in investing circles, but I will still attempt one. When I sort of over the last 20 years, I have read, heard, and seen him talk in various different places. The best anecdote I received, which is a perfect introduction for him, is when I came back to India in 2015 and 16, and I said, who would be a good investor to look up to learn from and whatnot. And he said that, look, there are many investors who have been kind of your spotted stocks, which are 5 baggers, 10 baggers, and stuff like that. And he gave me a few names. But if you want to sort of, speak to someone who has spotted 100 baggers, then there are only in that gang, only a few investors who can really talk about. And that talks about at least 30 years of investing plus. With that background, I went to, meet the gentleman who have got with me today, Sanjoy Bhattacharya. We call him affectionately Sanjoy. And I asked him the question that, how did you spot this? And the first thing he said that it's all luck, not skill. So not only was he kind of skillful, but also modest enough to kind of understand the importance of luck that comes about in investing. So, ladies and gentlemen, we have about an hour with him, and this will be about investing, and maybe we'll end with a view, etc. But without wasting further time, I would get cracking with regards to the first question that I have for Sanjoy. Sanjoy, welcome on the show.
Before you start, Trideep, let me say
welcome on the show.
I was lucky. And when I said that it's all good luck, I was not being modest. I was being truthful. So don't confuse honesty with, modesty. I think honesty, certainly, I hope that people see me as being honest throughout my life. Modesty, I think most people would disagree with you, Trideep. Most people would actually not agree with you. So thank you for that introduction, though.
Thank you very much, and welcome on the show. We have a very lively audience, which you will realize at the time of the questions. But let me start with a few questions that we had prepared for you. And I suppose you've seen multiple decades of investing, and in those multiple decades, you've seen many business cycles that have come and go. And in every business cycle, we sort of hear about certain sectors or themes. So the first question that I have for you is, and Howard Marks talks about this business cycle investing. So the first question I have for you is, do you really, having seen multiple cycles, do you really believe in business cycle investing? Or do you think there are certain cardinal principles of investing which kind of carry you through, irrespective of which cycle you are in? And the dominant factors are those principles rather than the business cycle. Would love to hear your thoughts.
I certainly think, first I should start by saying, I think Howard Marks is one of the smartest, most articulate and sensible people that I've had the good fortune to meet. He was in India actually a couple of years ago, and I had the good fortune to meet him then, and I've read his letters very extensively, and there's absolutely no doubt that what Mr. Marks says about business cycles is pretty much accurate. I mean, if you look at the history, the last 200 years history or the last 100 years history, going back to the 1920s in the United States of America, which is probably the world's deepest, broadest, financial market, there is indubitable evidence that business cycles do exist, that economic cycles do exist. And in fact, business cycles have a strong link with the underlying economy, economic cycles. And those of us who make an attempt to seriously understand the lessons that Mr. Marks puts across in his latest book on business cycle investing, I think would benefit significantly from it in investing. And sadly, today, this is a modern thing. And as you said, I'm, well past my sell-by date because I first started investing in 1983. But it's become a fashion to say that to understand cycles and cyclical stocks and the consequences of cyclicality is something that is beneath most people's sort of, what do I say, intellectual thought processes. They only want to look at a bunch of new buzzwords, which is quality and growth. And I think, in history, if you go back to the United States and you look at it, there have been these cycles, the Nifty 50 in the United States in the mid 60s, where, people said these are stocks that you buy once in your life and hold them forever. And I've heard those echoes ringing in India in the last 3 or 4 years, that all you need to do is buy the stock. You don't need to ever worry about selling the stock because they're so wonderful that they'll just grow forever and evermore till you reach paradise. So to me, I'm not in that camp. I think, there are definitely business cycles. Business cycles affect investing and the investment decisions you make. They're intricately linked to the economic cycle and economic policy, especially monetary policy and fiscal policy. And as far as I'm concerned, once you have that understanding of cycles, it helps you to make far more nuanced investment decisions. And I should add one more question. I think we are at the inflection point of a cycle right now, a turn in the cycle. So I think it's important to mention that in the context of your question.
So that was going to be the next question. Two strands to that. That in the context of what we have seen in the last decade or so, and you pointed towards the start of the cycle, would like to hear your thoughts on that. But I also want to bring in, another point or another aspect that this time, particularly in the new listed space, we are dealing with the so-called new age business models, which are, so to speak, fintech, consumer tech, so to speak.
The digital revolution.
Yeah. So, as someone who has seen, you counted US from 1920s, and I'm sure, there have been examples which were not really understood then, later people understood. How would you place these in the context of business cycle, the new tech businesses? And second, your point on the inflection point with regards to the cycle that we are in, if you could kind of cover those things.
So as Howard Marks says, I think, there are a number of sort of signals or indicators of, when cycles reach particular points, when he likes to use the word pendulum. So he describes it as the pendulum swinging from one extreme to another extreme. And if you look at, when does the pendulum swing to an extreme and then begin its trajectory backwards? So one is extremely loose monetary conditions, which we have had and continue to have, though the talk now is of setting that right. So we have had extremely loose monetary conditions for almost the last 6 or 7 years, if not longer. So that's one part of it. I think the second part of it, which is very important certainly in all economic cycles, and what it brings to the business cycle, is that there develops a mismatch clearly between what I would say is supply and demand, which is driven by, or basically, there are points in the cycle when prices of goods, of the real economy, are such that it is highly inflationary, or inflation begins to have a significant impact on the demand and supply of goods. And there are other points when it's just the reverse, when inflation, comes to very low levels. And that is really what drives interest rates. Central banks, looking at inflation, they decide what the price of money should be. And the price of money is pivotal in determining both an economic cycle and a business cycle. And today, the price of money is unprecedented in global economic history. It's close to zero. So I certainly haven't ever seen this before, but I've seen that, for instance, in the United States in 73, when Paul Volcker came, to chair the central bank in the United States, and inflation was running at double digits then. One of the first things Paul Volcker said is we've got to tame inflation, because regardless of the consequences and the price that we have to pay, if we don't handle it, it will destroy our economy and business. And in the next few years, he managed to get inflation under control. And then by 82, when he had completely managed to get inflation back to low single digits, the US took off on what is probably its most impressive and sustained bull run ever recorded in the history of US equity markets from 82 to 99. So that was driven by the fact that he fought inflation and brought inflation to a very manageable level. Today, we're at the point where for the first time, we have this mismatch or this paradox where you have very, very low interest rates and certainly inflation coming back from a pretty low and manageable level. So that's the second thing. I think the third thing is also availability of labor and wage growth, which affects the business cycle. And obviously that depends. If you have, wage inflation, then that affects consumption in turn. And so increases in consumption rev up an economy. So economies tend to get a boost from wage inflation. Today, interestingly, despite inflation rising, we're not seeing wage inflation. So all of these are pretty unique to our current circumstances. But there is very little doubt, in my mind, the single most important thing, I think, which is going to determine the next business cycle is the turn in interest rates to fight inflation. In other words, how central banks will act to set the price of money. And the price of money determines the value of today's earnings in relation to the future, and therefore what people are willing to pay for them. What we use in a shorthand, what we try to capture as the PE multiple. So PE multiples are affected dramatically by interest rates. And the lower your interest rates, the higher your PE multiples will be. So hypothetically, if interest rates were zero, you'd be willing to pay the same amount for 1 rupee of earnings in 2040 as you would be to pay in 2020. It would have zero impact on you. But if interest rates were 10%, then that would change dramatically.
Sure.
So that, I think, is the crux of, what will drive the next business cycle. Interest rate, and obviously capital expenditure, obviously consumption, bunch of things.
And how would you, in the context of business cycles, think about this new age business models, which are now kind of...
Yeah. Sorry, you asked me that. So I think this is a really fascinating period in economic history, because one thing is very clear about the impact of the digital revolution on our lives. And that, without a shade of doubt, and is going to continue, I think, as we go forward. There'll be lots of other social consequences and consequences which arise from the technology that is linked to each of these elements. But the biggest one is that is deflationary. That the technology, the digital revolution has unleashed a huge wave of productivity.
Interesting.
Which is the efficiency with which all of us as individuals can now operate. I mean, you look at it in our lives. When we didn't have email, when we didn't have, let's say, laptops, when we didn't have, high-speed internet, when we didn't have the telecommunications revolution, our ability to get things done was that much less. Today, we take it for granted. And I think the future will be the harbinger of even more revolutionary changes in our lives, like artificial intelligence, machine learning, which will affect us as users. Or for instance, cars which don't have drivers, autonomous driving and stuff like that. So not only will it have consequences for employment and so on, but the biggest thing is that productivity has gone up manifold in the last 10, 15 years and will continue to do so in the next 20, 25 years. And as a result of that, the secular long-term trend is deflationary. And that's a very, very positive feature. And it has implications for interest rates incidentally, which is why today maybe so many people are not so worried about inflation. So that's where they're joined. They're joined at that hip. The hip is where inflation meets productivity.
Very interesting point of view. I haven't heard, certainly haven't heard that. Let me just flesh that for myself and for the viewers a little more. So, so courtesy all this, the new age business models, you are saying that net, it will have a downward impact on interest rates, and structurally versus what we have seen in the past, it will kind of keep the interest rates lower for longer, everything else remaining same, basically.
But everything else never remains the same. That's the joy of our lives. So no matter that, I believe that, this is a highly positive impact on productivity, and in that sense helps to contain, inflation. The fact is that other things change. So yeah, it's good to get the big picture right on this. And the one other thing about the digital revolution, which we all need to keep in mind, is that it will allow us to do things in far more innovative ways. So it's not just about productivity, it's also about innovation. So there are two parts to anything in life. I'm sure you had a great education and you're a far more recent vintage than I am. So you know this, efficiency and effectiveness.
True.
Effectiveness is doing the right things. Efficiency is doing things right. I think there's going to be huge impact on efficiency caused by digital technologies in a vast number of areas, like digital printing. You can't conceive that a house can be built by using digital printing as a potential technology. It's possible. In the United States, people are actually doing this. And so what does that do to the construction industry? What does that do to material science? What does that do to a bunch of things? And this is the genome sequencing and the implications that genome sequencing has for drug discovery and the cost of R&D in doing drug discovery. So these are all things that, are clearly beyond my pay grade, my humble pay grade, but these are things that we need to think about very, very carefully when we think about how we will invest for the future.
Very interesting. Very interesting.
The shape of many businesses and industries will change in such a manner that someone who is looking at our conversation today in 2035 will say, these guys, I don't know what the hell they're talking about.
Yeah.
It'll be so different in such a short period.
And in your opinion, as you placed the history in front of us, how would you compare this level of disruption that we are likely to see over the next 10, 15 years with regards to what you might have seen or read over the last 100 years?
Oh, that's a good one. That's a really interesting one. I don't know how others look at it, but I can tell you how I look at it, because I certainly have been through a number of these. So I remember the time when we had to, ring up someone within the local place and place a trunk call to speak to someone in another city in India. So when I was young, when I was 7 or 8 years old, it was a huge thing to speak to someone in Calcutta or in Delhi, living in Ahmedabad, because you couldn't do it yourself. You needed someone else's assistance. So today we have the situation where we can ring up anywhere in the world with the click of a button, at the click of a button. Or for instance, that's the telecom revolution. The telecom revolution has also had a massive impact in ways that we don't realize. And it has had a massive impact on business and the way people trade and the way on investing algorithms. High frequency trading is a direct consequence of the telecom revolution, actually, and fat pipes. But, for instance, I remember growing up in the city of Ahmedabad, and, no one had any concern whatsoever in their minds about climate change and the environment. I mean, if you saw the amount of smoke and soot and dirty fumes and gas and, the city of Ahmedabad in the year 1965, you would faint. I mean, there would be no talk of climate change or caring for the environment. It was so dirty and so unbelievable. And today when people talk about it and I see what is happening, it's still raining in the month of November in Bombay. For me, it's really at some level, it's unbelievable. I can't imagine this, So the biggest thing that I saw, okay, I'll tell you another one. When I used to come home from school, so they used to change the engine because we had meter gauge railways and they had a steam engine. They didn't have electric engines at that time, so they would fill coal, it was coal fired. The train engines were coal fired. So they would load coal and then stoke it and, it would take half an hour. It was at a particular point on the journey and they would change the engines and then I could get home back to Ahmedabad. So when you imagine that and you see magnetic levitation, when I went to, Shanghai and I saw trains on magnetic levitation, I knew that the world had changed around, So these are the kinds of things. And I think, it's just like what happened at the turn of the century when the car, Henry Ford and people before Henry Ford actually, or the aeroplane was invented and commercially developed. So that people couldn't imagine what that would do to transportation. And many people got it wrong. So if you had bought some of the early car manufacturers or some of the early airlines, you would have gone bankrupt pretty fast. As they say about, mining gold, don't buy the gold miners. Buy the people who make the shovels and the picks and buy Levi's. You know how Levi's came about? It was basically something that the gold miners wore when they went to work. That's how denim got invented and how Levi's was set up by the Haas family. Levi's has survived for 120 years, but gold miners have not. And a lot of the gold mines, the companies which mined gold in the 1900s, you wouldn't know their names today. Today, you know the names of Newmont and Barrick and whatever, but those were not the original gold miners. So I have a sense that many of us who are obsessed with, the individual companies today are going to be in for root shocks because the disruptors will become the disrupted at some point.
Very interesting and thought-provoking. Very interesting. Very interesting.
And there's a book on this, which, for those of you who are like me, who have too much spare time on their hands and who are interested in it, there's a book called The Genius Makers. It's written by a guy called Kate Metz, but it's an absolutely wonderful book. If you want to try and understand what the future holds for us in a language that is understood and readable by the common lay guy, people like me.
Very interesting. Very interesting. One final bit on onto another strand of investing which is coming about of late is this international investing. Obviously, earlier people who kind of had bank accounts everywhere could do the same, but now more and more Indians are looking to invest internationally, sitting in India. I wonder, from your, what is your perspective onto that, and how do you see that evolve over time? Do you think this is a fad, or do you think this will kind of grow bigger from here on? Whichever direction you want to take it.
First, on a lighter note, I should say that so many Indians, they seem to know the value of the Dow Jones and the S&P when I wake up every morning at 6:30 or 7, that I think everyone actually, we should have just one global market. They should shut down stock markets everywhere in the world and just have one market. Because we're so obsessed. US ka upar tha, Dow upar tha, to aaj India upar hoga. If that's the case, then why do you need multiple markets and so many companies? Just have one market and speculate as much as you want in that one market. But having said that, no, I think to address your question more seriously, yeah, it's a wonderful thing that now with LRS, the Indians can invest, abroad. And my sense is that they would be well advised not to try and do it themselves, meaning not find a DIY approach to investing internationally. They need to, first sort of understand the differences as well as the similarities. See the similarities in the differences and the differences in the similarities between investing in India and investing abroad. And, I think this is all because we have a currency that is closed. The current account is not open. And I can't understand why, we're so proud of having $650 billion of reserves and we have a non-convertible currency. I mean, this is one of the eternal mysteries of economics for me. I just can't get this. I hope this changes during my lifetime in the next 10, 15 years. But it's a trend that is bound to take root, meaning Indians will begin to want to diversify away from just the Indian market. And at the rate at which we are producing unicorns and billionaires, you can be guaranteed that this trend has a future. And I think you guys do a wonderful job, actually. I think Edelweiss has some very interesting funds, the China fund, which I've looked at quite closely. And it's very much a thing of the future. There's absolutely no doubt. And I think, people like you and me may also have a little bit of difficulty because soon robots will invade our turf.
True.
So we must be on the, alert to make sure that we are not made redundant.
True. And I think, thank you for your kind words for Edelweiss. I'll change the tack of questioning to learning from Sanjoy Bhattacharya as an investor. Both from your successes and your mistakes.
Primarily my failures. I don't think I've had that much success. I think people have a misplaced notion of my success, but it's certainly instructive to, talk about my failures because I've had many. I could go on for hours and hours together. So I think one should focus on that.
So since you picked the question, what have been in your career, 3 big mistakes that you've made that kind of that gave you learning, which the audience can learn from as well?
Yeah, sure. I mean, I wish we had lots more time because there've been so many, but I'll try and focus on the big ones. So when I started out investing in 1983, I made my first investment in September 83. I had not really got too much of an introduction to finance or to accounting. I had studied marketing when I did my master's degree in management, and I really had no goddamn clue about a balance sheet because, like most MBAs, I mean, I didn't know. I just managed to get to the course and said debit, credit, something in my head, but I couldn't make a balance sheet balance. So I said I was more or less just a common sense kind of guy, and I, knew certain things. And actually, if I had remained as I was in 1983, I suspect in 2021, I'd be making a lot more money because my approach then was to look for the big reliable brands and the people who are growing and who had, really well-known managers, which is an approach that I probably moved away from very significantly because now I'm much more focused on financial statements and, stuff like that. And maybe that's what happens to all of us. As you grow senile, you do dumb things with regularity. But the one big mistake early on, which I learned in my life, and I'd like to share this because it's probably been the costliest mistake in my life. And most people don't associate me with this, but it's very important to learn from my personal mistakes. So the first share I bought in my life in 83 was a company called Asian Paints. And I remember buying 200 shares of Asian Paints on, I think, the 16th or 17th of September, 1983, for the princely sum of 53 rupees a share. That's about, it exhausted about half my savings. So I was pretty low on fuel after I bought those 200 shares of Asian Paints. And I had an undiversified portfolio for the next 3 years. I didn't buy a second share. From 83 to 85, end of 85, I just owned 1 share. And, I was very impressed by how it just kept on blossoming and growing. And then I got a bonus. It was a 3 for 5 bonus. And then I said, gosh, this is wonderful. It grows on its own without putting in money. And then I went, and then their office used to be in a building in Nariman Point called Nirmal. So I said, let me find this building. And I went up to the 5th floor, and I'm what they call not an atheist, but an agnostic. But I went to Nirmal to the 5th floor and I held my hands, and saluted all the gods that prevailed in the 5th floor of Nirmal, because for me, it was the ultimate temple. And I continued doing this for years, even when I'm not an Asian Paints shareholder, because it was just magical. The share just kept on going up and up and up. And, and then we had an income tax rule in those days, which said that if you have capital gains was 3 years then, and if you sell a share after 3 years and you buy a property with it, then to the extent that the property meets the magnitude of your total capital gain, you don't have to pay any tax on the capital gain. So suppose I had a capital gain of 25 lakhs and I bought a house for, let's say, 25 lakhs or 28 lakhs, I wouldn't have to pay any tax on the 25 lakhs of capital gains from the long-term capital gains arising from. And the wisdom was that the first thing that you should do is to buy a house. You should become independent so that you can, you can have the freedom and flexibility to pursue your career as you wish. So in 1991, there's a place called Nalasopara, which I think Trideep probably doesn't know, but I certainly have an intimate understanding of the place because a company called Shaw Wallace, who was completely new to construction, decided to build a wonderful residential complex in Nalasopara. And they were very easily available. There was a nice big, flat, which was way bigger than I thought, available at some ridiculously low price. And so I could put my entire, what I had invested in Asian Paints by 11,000 rupees. I had capital gains of about 10 lakhs from that 11,000 rupees.
Wow.
So I said, if I put this 10 lakhs, I can buy a big flat in Nalasopara, huge flat. And who cares? I'm not going to live there. And even if it takes Nalasopara was a swamp. It had mosquitoes. It was just like a total malaria sort of, what do I say? A mangrove for mosquitoes. And there was no water connection. There was barely electricity. But I said, this is how you got to think long term. The electricity will come, and if the people come and buy flats, then the water connections will come and they'll get the mosquitoes removed, and it'll all happen, and you got to be patient. So I shouldn't be worried about buying a flat. So I bought a flat in Nalasopara with the 10 lakhs, paid zero capital gains tax on Asian Paint, and I was a proud owner of a 3-bedroom flat, a very large 3-bedroom flat. And I did this in 1991. So I held Asian Paint from 83 to 91, multiplied my money 100 times, then bought this flat. And then from 1991 end till 2007, nothing happened in Nalasopara. It was a complete disaster. And by the grace of God and a lot of help from, well-wishers, I managed to sell what I had bought for about 11 lakhs in Nalasopara in 2007 for about 12.5 lakhs, 16 years later. So I made 10% on this brilliant investment in Nalasopara to avoid paying tax on 11 lakhs. In 16 years, I made 10% total. I had sold my Asian Paints. I no longer held a single share of Asian Paints, but I had saved tax and I got myself a house. The lesson from this is never, ever, make the mistake of linking the sale of a share with how much tax you have to pay on the sale. That is a cardinal lesson. Never be happy to pay taxes. The fact that you're paying taxes means that you made money, and making money is fundamental to investing. You won't have to worry about taxes if you lose money. So the very fact that you're paying tax should be a source of pride and joy to you. And it is not a consideration. It should not even cross your mind how much tax you have to pay when you decide to sell. That's lesson number 1. Lesson number 2, and this is, I would say, as big a lesson as lesson number 1. There are very few companies in this country which are truly exceptional. If by sheer dumb luck you happen to find one of them, like I did, don't get rid of them. Because these are the companies that have the ability to grow for really long periods on a very consistent basis and make really serious money. And so, if I ask you guys, what is 1.2 to the power of 20? I don't think too many of you would have the answer. But just let me assure you that that's a number that is so large that most of you would be delighted to know what, to hold something for 20 years. I actually bought a stock in 1995 called Infosys, which sort of emphasizes the power of 1.28 to the power of, for me, 23. I held Infosys for 23 years.
Wow.
And that's not wow, actually. That's incredibly stupid. It shows what an idiot I am, because I should have sold it in early 2000, but I didn't. So, but the point is, when you find a really high quality company, remember that if you want to sell it, it's going to be very, very hard to replace. So don't be in a rush. You have to have a very powerful and a very well thought out reason to sell exceptional companies. Please don't do it on a whim or a fancy. Take a long, long time. So that's mistake number one with 2 lessons. Then there's a second one, which I think people make every day, very common. And I've done it millions of times. I think I continue to do it, but I feel sick in the head every time I do it. So just because something has a low valuation multiple doesn't mean that it's going to offer you a greater margin of safety. Many people confuse cheapness with safety. So in investing, the margin of safety, these are the 3 most important words. Believe me, even in 2021 and 2061, these will be the 3 most important words in investing. Margin of safety. It protects you against yourself and your stupidity and your errors and your misjudgments. So please make sure that you have it. But margin of safety is not related to the absolute price of a stock. Margin of safety is related to the nature of its business. Because that is what drives your ability to handle adverse events which impact the stock. It is not the absolute price. So a low PE multiple, a low price to book, a high dividend yield, a high, by whatever metrics you happen to value stocks, EV to EBITDA, price to operating cash flow, there are 3 things that you need to think about. 1, are they sustainable? Because at any given point in time, the fact that something is low is no predictor of what the future will look like. And therefore, your ability to hold that stock and compound it and make money. 2, what is the reason for the cheapness? You're not the only genius around on Dalal Street. Believe me. Much as all of us like to think we are blessed with a supreme level of intellect and genius and smarts, none of us are. If millions of other people voting with their feet and their money think that a stock is cheap and it doesn't get noticed, that itself should be a warning signal and should give you great cause for concern before you rush into it. Because if other people voting with their feet don't think it deserves a higher multiple, if 10,000 guys are doing something and you're doing the reverse, chances are very low that you are the smart guy. Point number 3, very often the cheapness is driven by our inability to understand the future consequences or the lack of certainty that relates to that company's business itself. So while it may continue to do well for 2-3 years, like Hero Honda and Bajaj Auto today, but the inability to understand the consequences for the 2-wheeler business 5 years down the road is something that has a central impact on how you value that business. So current cheapness, and I'm not saying that this is either a reason to buy or to sell the 2-wheeler companies. Neither way. That's a completely independent course of analysis that you need to go through and figure out and understand. But every cheap stock is not a gold mine. Okay. Final lesson, since I've had so many failures, I just talk about a third one. which I think is also pretty instructive, and which again is reasonably commonplace. And again, it affects a lot of people. So I've always said one of the greatest things that you need to succeed in investing is humility. And what is humility? When you make a mistake, for heaven's sake, accept that you've been stupid. But most importantly, in investing terms, having recognized that you're wrong and that your hypothesis is broken and that you made a mistake in either judgment or analysis, please act on it promptly, regardless of whether you're an investor or a trader. If you're a trader, it's even more important. But even as an investor, once you recognize, and many of us don't even recognize, we're not even smart enough to recognize we've heard. We think, oh, this is temporary, now the price will turn, it's going through a rough patch, all the other companies are also down, so I shouldn't be too worried, I sell too quick, we've got to be more patient. The power of compounding is magical, so this company is going to compound. We find 23 reasons to just stick with our stupidity. But once you figure out, and this is the difficult part, figuring out that you're an idiot. But once you've figured out you're an idiot, for heaven's sake, don't waste time acting on it. Compounding works in both directions. It works on the downside and it works on the upside. And the dumbest thing most individuals can have in their portfolio is what I call dead money. Money that has no chance of appreciating. And the less dead money you have because of errors of either judgment or analysis, or lack of, or what I call intellectual arrogance, a lack of humility, the poorer you will be. Because the market is unsparing. It just doesn't give you a second or a third chance. So if you got it wrong, accept it, act on it, and from there, as Trideep spoke earlier, comes learning. And you are then on the path to becoming slightly wiser. Once you begin to see the mistake you made, you accept it, you don't personalize the mistake and begin to whip yourself, but you think about your mistake constructively in a depersonalized manner and say, okay, what's the lesson here? What can I do better next time? What should I not do next time? And take that away and put it into a box and then apply the tools in that box to other stocks that you buy. Chances are that on a long-term basis, you'll be a far superior investor. Yep. So, but we can hold a session separately, Trideep, for all my mistakes. This is just 3 of the most common.
And the way the questions are pouring in, I can see that we can go on and on. But one I want to pick from this, from the questions, because it's very topical. We'll come to questions a little later, but which is saying that, are you saying that one should not be contrarian in the way that you've described your mistakes?
So, okay, this is I've written actually extensively on this. So being contrarian is very interesting. I'll try and keep the answer really short. Being contrarian just doesn't mean being different from others. Being contrarian means that you do a whole lot of homework, that you really put in the effort to look at the set of facts, data, evidence, history, background, people relating to a particular business. And then if you have a point of view that is genuinely different from what the conventional thinking is on that particular issue, then you back that to a massive extent. It's also what, people in America call variant perception. But the variance in your perception must be rooted in incredibly deep understanding of the business, huge amount of data crunching and analysis, and an understanding of what the future holds. That is what differentiates contrarians from people who are followers of the herd. And for most people, that is missing, because the uncertainty relating to the future and what it will bring to a particular company's destiny is very tough. If you can get that right, then you must be contrarian, and contrarian in a huge way. But you shouldn't be contrarian simply because you want to be different from others, or you think that the valuation is, cheap and others think it's not. That's not intelligent or rational contrarianism. The rational contrarian is the one who accepts that the herd is very smart. That is the first principle of being contrarian, respect for everybody else. Once you've got that in your mind, then you begin to ask yourself, so at the margin, what is changing? And do I understand this? What does the future hold? Is it really different? And is it going to sustain? So I'll give you one that is very controversial right now. Should you be buying the relatively better PSU banks? Or should you stick to buying well-run private sector banks with a glorious history? And I'm not going to offer any solutions here. But this is the kind of circumstance where the facets of sensible contrarianism may come into play. Yep.
Great answer. So in a similar similar point that you made, this is the questions. I'm going to read it out verbatim. It says, I have a full-time job. I can't track markets and companies frequently. So should I be satisfied with coffee can investing method, or should I just stick with the Sensex mutual fund?
So this is a wonderful question, actually. I don't know how many people know the origins of coffee can investing. It's a guy called Robert Kirby, who used to work for what is called the American Funds Group in the late 50s. And the background to coffee can investing, which actually Saurabh Mukherjee quotes in his book. And strangely, I'm quoted there as well. So I feel, like I'm in some kind of dream sequence whenever I'm asked about coffee can investing, because I was probably the first guy in this country who became aware of it. And, told other people of the merits of coffee can. But let me give you the short answer. Like Mr. Buffett, this is one of, I think Mr. Buffett is a dramatic intellect, and what he has brought to investing, very few people before him, and I think after him will bring to investing. This is one of the things that I think he has really made clear and said even about himself. If you don't have the time to put in the hard work and the effort to understand what's going to happen, buy the lowest cost ETF which has scale in the market. Forget everything else. It's very difficult for the vast majority of human beings to beat a low-cost ETF. And if you want to understand the success of ETFs, you don't need to go any further than look at what has happened in America in the last 10 years. The ratio of active money to passive money and how that's changed and how the flows have gone. And believe me, India is no different. There will be the Trideep Bhattacharyas of the world. A few. But by and large, active management is going to have to fight really hard to deliver most investors a truly attractive value proposition. So, simple answer, buy low-cost ETFs, hold them for extended periods of time, start early, save more.
I think a couple of questions that have come about. Actually, one of the topics which in the wake of questioning I forgot is basically the impact of behavior on investing. And we can hold a session separately on that. But I think in one of the sessions I heard about, you talk about some very fascinating part of it. So it would be great to hear your thoughts on, behavioral aspects with regards to, how to when to make investing decisions and when not to.
Actually, the Bengalis, and both you and I sadly are Bengali, or not sadly, why sadly? Both you and I are proud to be Bengalis. And there's a lot that for the typical Bengali comes into play here, but I'll try and isolate it from that. See, what is behavioral investing? Why is it important to think about how you behave when you invest? Because at its essence, most of us do not understand who we are. We are our own worst enemies. And we are not truly in control of our minds. That's the crux of behavioral investing. If you ask me what is behavioral investing, it is, do I know myself? And do I have control over my mind? So this thing called greed, if we could come to terms with greed or with fear or with, let us say, why we are not patient, impatience, or anger, if we could come to terms with these kinds of issues, then the context of our investing would change dramatically. What is the most common phrase that you hear today, the modern day investor? 100 baggers. That is where Trideep started today with me. That's why, in a sense, I feel very ashamed about it. Sensible investing is not about setting out, seeking to find the next 2-bagger, 3-bagger, 10-bagger, 20-bagger, 100-bagger. No! Sensible investing is bringing to bear discipline on a simple set of things that you do, that you tick off, that you put in place before you even think about what you should do in an investment decision. And if your investment objectives and time horizon are distorted by what your mind wants and what you know is the smart thing to do, then you will be seeking 100 baggers or 10 baggers or 5 baggers, because these are not rational outcomes. If you drew a bell curve, and there's a very interesting article by Morgan Stanley Asset Management, that if you looked at 6,300 companies and their performance over the last 50 years, less than 20% beat the performance of the index. In other words, out of 6,300 companies, only 1,200 companies over 50 years beat the index. Forget multi-baggers. And of those 1,200, less than 5% became what we would call serious multi-baggers in a 50-year time span. So that tells you how unlikely these outcomes are. So if you distort your thinking and your mindset to trying to achieve exceptionally rare outcomes, you're going to distort the process that you bring to bear on making investment decisions. And you don't need to do that. Remember that the stock market reflects an underlying economy. The trend of all economies, most economies, unless they are centrally controlled and there's someone who's a lunatic in the control room. But most economies have an upward sloping slant because of the way that people, what we spoke about earlier, productivity. As the world becomes more productive, automatically for the same number of hours worked, you get more output. Right? So there is an upward sloping slant to all, not all, to most economies in the world. So you're guaranteed positive outcomes, positive returns in the stock market. Now your challenge is to beat inflation and after taxes to preserve purchasing power. If you can do that, in real terms, you'll grow wealthy. So you've got to ask yourself, what are the set of things I need to do to achieve that? First and foremost. Then, what are the things that lead to good outcomes which are reasonable over a long period of time? And if you do that meticulously and you are honest with yourself and you're in touch with reality, you don't distort data and distort your interpretation of events and sequences to come to bizarre outlandish conclusions, you'll stun yourself with how by just being sensible and being rational and applying common sense, you will, the kind of outcomes you can have. They can be truly, truly exceptional because the human mind cannot envision extreme events. We all assume the world is Gaussian normal. The distribution of outcomes is Gaussian normal. But the stock market does not have Gaussian normal outcomes. This is the worst assumption people make. Stock markets follow power law distributions. If you doubt this, read a guy called Benoit Mandelbrot. So cotton prices, stock prices, they do not follow Gaussian normal distributions. Otherwise, you'd never be able to explain 99-2000. You'd never be able to explain 1987. You'd never be able to explain 2007-8 or 2020 March. The occurrence of so many extreme events in such a short period of time. Because the central tendency, the mean return and the standard deviation around that central tendency is well documented in Gaussian normal distributions. But the mind doesn't want to accept that in a bell curve, there is a left-hand side to the bell curve. Today also in India, vis-a-vis how markets are valued, people are not looking at the left-hand side of the bell curve. We are on the extreme edge of the right-hand side. And yet there is absolutely no concern. And most people think the stock market is actually Gaussian normal. Given that assumption, I think a whole lot more caution is warranted, but that assumption itself is not right. Because as I said, stock markets follow power law distributions. Okay. So the simple point I would say is, stay honest, be objective, be meticulous and disciplined, get control over your mind, try to be detached. The more detached you are, you should not be investing to get rich. This is a paradox, isn't it? That you should not be investing to get wealthy. Then what the hell should you be investing for? You should be investing your money because you enjoy the journey. And investing is a journey. That's why the guys who don't have the time to make that journey should buy ETFs. But if you're making the journey of being an investor, a serious investor, then the only thing, there are lots of things apart from getting rich that are very important. And I think many of us miss that. It's like when you're a professional golfer, as you walk from hole number 1 to hole number 2, you cross the bridge across the water hazard, you see the little sparrows chirping in the side, you see the sand in the sand trap, there's a certain nip in the air. You experience all of that, and that's part of the joy of playing golf. It's not just what you sign on your card at the end of the day. Investing is just like that. Learn to enjoy the journey and be in control of, what you want to do. Is not just about getting wealthy. That is just one outcome. Along the way, as you invest, there are many, many things you learn about your own life that are invaluable. And investing actually mirrors life. The good investors are typically, and Buffett says this as well, investing is about character. If you want to build character, learn the lessons of investing. Have purpose, be disciplined, think long term, don't try to harm other people. These are the lessons. Or if you look at the favorite national sport of India, cricket, the best batsmen are the most disciplined batsmen. They don't play aerial shots. Sachin Tendulkar, Sunil Gavaskar. They are disciplined. They play in the V. They leave a lot of balls. They're not trying to smack a 4 or a 6 of every ball. If they did, they'd be back in the pavilion much quicker. They're not looking for multi-baggers. They are running the singles and the twos really hard because they know how difficult it is to pierce the field, and they have respect for the bowler. So same thing with investing. Same thing with tennis, which Mr. Bhattacharya, Trideep Bhattacharya loves. If you want to be a great tennis player, focus on executing the shots that you play correctly. It is not about trying to be spectacular, trying to kiss the lines on every shot that you hit. It's about creating openings. So if you want to win points, you play percentage tennis based on a plan that you have. Same story with investing. So you've got to have, rational return expectations. In my case, I'd be delighted if I earned between 15 and 18%, including dividends, on a 10-year block. If I could do that, I'd be delighted. But I think that most people nowadays think that that's really pedestrian. And I wish all of you who have more ambitious return expectations the very best of luck, and enjoy yourselves, because I don't think that journey will end happily. You'll have a blow up somewhere, but while you're at it, enjoy yourselves.
I think there are many questions in the chat, but I think this is a good way to summarize a session on investing. We've had market views. You had many sessions that you will hear in public market channels. This, that, the other, we talk about market view, but very few sessions we talk about investing. And I think the way Sanjoy summarized that overall, it's about the process, it's about the way of thinking, it's about the way to make it happen, and the discipline rather than the outcome is a great way to summarize that. Thank you very much, Sanjoy, for.
Can I just, before you conclude, can I just say one thing? Because this is also very Indian.
Sure.
So in a way, investing is a lot like religion. Why do we seek religion? To have peace of mind, to have that stillness in your head, so that you can hopefully begin to feel more secure within yourself. That's really the purpose of religion, right? So some of us find it by going to temples, by seeing idols of God. Some of us, different religions have different ways of helping us to reach that peace of mind. And as I believe, and I think it's not difficult to figure this out, there is no holy grail. There are multiple religions. Each of them is the way of those people in trying to achieve this universal stillness and peace of mind. Right? So also in investing, there is no holy grail. Value investing, momentum investing, quant investing, algo investing, there are many, many, many ways to invest. No single approach to investing, provided it is done with discipline, with a sense of purpose, with clarity about where you're trying to reach, is right or wrong. What is very important is to have the belief that you are seeking something that is important to you, specifically to you, the individual. And how are you going to get there? Where are you today in that journey? And where are you seeking to get? It's not about the method. It's about the belief that you want to go through this journey. And it's not that any one religion is better or superior or preferable to any other religion. So let no one ever tell you that value investing is better, or growth investing is better, or you'll become richer quicker. That is the ultimate humbug. The only truth is to be true to yourself as an investor. Thanks.
Thank you very much, Sanjoy. It was great speaking to you. We hope to have you at subsequent sessions as well.
My pleasure. It's a privilege. At my stage in life, very few people want to have me, so I'm really thrilled to be here.
And I'm sure that's not true. Thank you very much. Thanks everyone for tuning in. Cheers and goodbye.
Bye.
Have a good weekend.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.